Hello traders, in this video we will see about the advantages of options buying and its drawbacks and when to buy options. First, option buying advantages are it involves very low risk and it fetches you a high reward. The maximum loss will be the premium paid. So it has the capacity of high yielding profits. So I am going to explain it with an examples. So let us see in an Opstra defined edge platform. First open index Nifty and select options and choose the expiry date and choose option strike. The current spot was 17,173. So I'm expecting the market to go above 17,100. So I'm choosing 17,100. Sorry, 17,100 strike price and add position. So here I am getting the payoff chart for this option. So first one was one lot is 50 quantities. 13th October is the expiry date. 17,100 is a call option strike that I have chosen, and the premium that I paid is rupees 100 for one quantity. So the maximum profit you will get in this option strike when the market goes up is undefined, because the market can go at any place within 13th October. So the break even point is the point where your profit starts at the expiry. This is the payoff chart of expiry day, and the blue line that you see here is the notional line that you will see the profit and loss when you on the current market condition. So the maximum loss here, it was 5,000 rupees. This 5,000 is the premium paid. So I'm showing you how the 5,000 was calculated. 50 quantities is the Nifty slot size into the premium. The premium you paid is 100 rupees. 100.8 is equal to 5,040 rupees is the maximum amount that you paid. Here you can see estimated margin and premium. So the break even point is 17,201. This is calculated by the strike price that you have chosen plus the premium of that strike price. 17,100 plus 100.8. So 7,200.8, roughly 17,201 was taken. So after that 17,201, 202, 203, each 1 point will be a profit of 1 rupee. So the risk involved is only the premium that you paid. So this is very low risk and the reward will be maximum. You can see here 14,000, 15, 16,000, and it is undefined. So that's why in the maximum profit zone it was showing undefined profit. This is the advantages. Next I am going to show you the drawbacks in the option buying. The main drawback is the value of the option strike will become zero if it expires out of the money. That is, in the option chain you see here, this is at the money strike. These are all out of the money for call options. These are out of the money for put options. So you can see when the strike prices go far away, the premium amount was very low. So at the end of the expiry, if the market stays below the strike price that you have chosen, the premium will become zero. So that's the loss that you have seen in this chart. So the 100 rupees will become zero if the market does not go there. So that's why the lost amount is completely the premium that you paid. The option strike will lose its value due to time decay. This is very a good friend for the sellers and the enemy for the option buyers. That is, consider if you have chosen 70,100 call option and you paid 100 rupees. On the next day the market stays in the same spot, market opens flat, but the premium that you paid will be reduced to 80 rupees or 70 rupees. This is because of time decay. So the probability will be very less. So the profits will always reduce. The chance of going there will reduce. So the premium will be reduced. This is a great enemy for the option buyer. Most of the option buyers will get into this trap. And the next drawback is it will not give you high profits in a range bound market condition. So for example, the market starts here. Just a moment. I will show you in Nifty. Here, see here, see here, take this day. Here the market opens here. If anyone bought options at this place, the premium will reduce high. It will go up, reduce, go up. At last the market was in the same place. It does not give a heavy movement either upside or downside, so the premium will be reduced. So this is a bad for, and this is not give it, and this will not give profits for the option buyer. So it will not give profits in a range bound market. So these are the main drawbacks for option buyers. And next is when to buy options. This is very important. Not all the times are ideal for buying options. During volatile market conditions, you can buy options, because when the market is very volatile, you will get the premium spike. That is, the premium will get increased. So you can get benefit from that. When the market will become volatile, so in the event days like budget, during any pandemic or any global issues that affects the economy, during those events you can try options buying by proper risk management. And when you will find the market will become volatile, so this is an indication. Generally, when India VIX, you can see India VIX in chart, it will generally it will not have a proper number, but generally if the India VIX value is above 20, the market will tend to be violent conditions. So when the India VIX is above 20, people will trade option buying, and it will be good for them. So they will try options buying when the India VIX is above 20, so it will give more violent moves. And this is very important, choosing in the money or at the money strike price when you buy options. Here in the option chain, I have said that these are at the money strikes, and these are out of the money strikes, and these are in the money strikes for call options, and these are in the money strikes for put options. These are at the money strikes for put options, and these are out of the money strikes for put options. So I am explaining it by taking call option as an example. See here, if you take 17,100, so the premium you paid is 100 rupees. So 17,100 plus 100 is the break even point. So I am giving an example here. So the break even point is 17,200. So after 17,200, every point will fetch you profits. Now I am showing you same Nifty 50 options, same expiry, but I am choosing here the out of the money option. That is, I am choosing 17,200. Okay, 17,200. You are buying it, same on lot. The price is 51 rupees. See, the break even point is 17,251. At the money strike, the break even was 17,200. That is 50 points the higher. So there is a more chance of losing when you choose out of the money options. And in case of in the money options, I'm giving an example for that. Same Nifty options, 13th October. I'm choosing, the market is on 70,000. I'm choosing 16,800. The price was 341 rupees. Here the break even is 17,142. So you see the differences. In the money strike 16,800, the break even was 17,142. In at the money, the break even was 17,000. The break even was 17,201. And out of the money, the break even was 17,251. So when you choose the strike price away from the spot price, you will tend to have the very low probability for winning. The break-even points will be extended. So option buyers have to prefer in the money or at the money strike prices. These are very important. Since the out of the money options premiums are available in a very less value, people tend to buy that and caught in the trap. But the probability of winning is very less in case of options buying when they choose out of the money strike prices. So these are the important points that you have to remember before buying options. In the next video, I will come up with a video about the advantages, disadvantages, and when to sell options. Thank you.